record this for the rest of the class. So, um, when we look at instances like these, first of all, we have to do journal entries here, and this is exercise 4.3 from the text. So we're looking at journalizing here, and let's see, the company uses perpetual inventory system and a gross method, which means basically whenever we are looking at selling items, because it's our decision on what method we use when we're the seller. Um, what we'll be doing is looking at these things at full value, and then if we end up taking a discount, we will adjust for that then. So basically what I'll have here, move some of this down a little bit. We've got a little area over here to do our transactions, and we'll just go down through and talk about these. So April 2nd, we purchased $4,600 of merchandise from Line Company with credit terms of 215 net 60, invoice dated April 2nd, FOB shipping point. So when I see something like this, the first thing I think of is from the company, well, we purchased $4,600 of merchandise from this other company. So we should know the merchandise inventory is an asset. We own it until we sell it. So when we look at this, we're going to debit our merchandise inventory for the amount we purchased, the 4,600, because this is the gross method. So we're going to put everything down at cost. And if we take the discount, we will adjust then. So it says we did this on credit terms, which means we're not paying for it now, we're paying for it later. So we have accounts payable, and this is Lion. And I think we're going to start seeing designations here between different types of accounts and the customer name. So we're doing Lion here because if we have more than one customer, we need to keep their accounts segregated because we want to know how much customer A owes us compared to customer B, and so on. Now, accounts payable, 4,600, this is going to be exactly what we have on the debit side. So we've got our asset and we created a liability here. Now on April 3rd, we paid $300 cash for shipping charges on the April 2nd purchase. Now, this is as I say at the top, a perpetual inventory system. And in a perpetual system, most of our costs when we're purchasing items go into inventory. So although we paid the cash for shipping, because this is a perpetual system, it's relating to the cost of us acquiring the inventory. So we're looking at this again, we're going to put the cost for this shipping into merchandise inventory because it's part of the cost of us acquiring these goods. So, and if we paid for it, of course we will, credit, that's better, cash. And that'll be for the 300 also. Since we paid it, cash goes down. Cash is an asset, has a normal balance on the debit. Means it would increase on the debit. Since we're paying cash, it decreases on the credit. Now on April 4th, January, February, March, 4, we have returned to Line Company unacceptable merchandise at an invoice price of $600. So what this means is what we ordered on April 2nd, that $4,600 of merchandise, we're returning 600 of it because we can't use it. It's unacceptable, whether it's damaged, wrong color, wrong size, it doesn't matter to us, it's unusable. So basically what we're doing here is if we're returning 600 and we think about this logically, it means we have $600 less of inventory and we also owe $600 less on the liability. So we will debit accounts payable for Lion because our liabilities have a normal balance in the credit, they increase on the credit. Since we're decreasing the liability here, we will debit it, and we're going to debit it for the amount we sent back, the 600. Now we credit merchandise inventory because now this inventory, we returned it. It's not ours anymore. We don't have it available to sell. We can't list it as an asset because it's not there. Okay. So now we got what April 17th is our next one, 4/17. And we're sending a check. So we're paying for the April 2nd purchase, and it has net of discount. Our terms are 210 net 50 or 215 net 60. So we do get the 2% if we pay it by the 17th or sooner. We do pay it on the 17th. So basically, in this sense, we have to think, okay, well, what do we owe this lion company? Well, if you remember, we bought $4,600 worth of stuff from them, but we returned 600. So we owe them $4,000. So if we're going to pay this in full, we have to designate that, and we have to debit our liability 46 or not 4,600, 4,000, because the 4,600 that we ordered and then the 600 we returned would mean we owe them $4,000. Now, we do get the discount, which is 2%, and our 2% is only based on the amount that we owe, not on the 4,600 because we returned 600. So it's only based on the 4,000. So basically, that 2%, if we multiply by 4,000 is 80. And then the rest of the amount would be, if we're paying this, we're paying in cash. So we're going to credit cash for the 39.20. And then what we have here, if we think about this, again, this is a perpetual system. So we're looking at this from the basis of everything runs through merchandise inventory. And in this case, we had $4,000 worth of inventory here, but we get a discount. We get 2% off. We get $80 off of this. So really, our merchandise doesn't cost us $4,000. It costs us $39.20 is what we're paying for. So to adjust for that, we ordered 46. Okay, we returned 600. We had 300 in cost for the freight and the shipping in. And what we have here now, we have to credit the merchandise inventory because this cost less than we thought it would cost. So if you think about it, it should make sense. If you're going to buy, if you go to buy something and you plan to spend $20 and you only spend 15, you save $5. What you bought didn't cost you 20; it cost you the discount less. So with that amount of discount comes off of the merchandise inventory. And then we have on 418. The next one, we're purchasing $8,500 of merchandise from Frist Corporation, or 110 net 30, invoice dated April 18th, FOB destination. Okay, so $8,500 of merchandise. So if we're purchasing this, what we're getting merchandise inventory for the 8,500, and this is on credit terms, so it's accounts payable, and we will designate this to Frist for 8,500. Now, on the 21st, 421, we know we're doing something here. After negotiations over scuffed merchandise, received from Frist a $500 allowance for the $8,500 owed on the April 18th purchase. Well, basically, this is kind of the same thing we would have here if we were sort of returning something, where we owe less now because they gave us a $500 allowance, so we owe 500 less. And also, if we're paying $500 less for that merchandise, then we can't count it at the original amount we bought it at. We have to count it at that amount minus 500. So for April 21st, what we're going to have having here is we're going to debit our accounts payable because we owe a little less now to Frist for the 500 discount they gave us. And then also we're going to credit merchandise inventory because we paid less for this inventory than we thought we were going to. Now, our last entry on the 28th is sending a check to Frist. So if we want to write a check here, we're going to send a check for them. We're saying we're paying them for the purchase we made, net of the allowance and the discount. Okay, so we can see over here we owe them $8,000 now. 8,500 was what we had purchased. We returned 500, or they gave us an allowance for 500. So we really owe them $8,000. So we know if we're paying this, accounts payable to Frist for the $8,000. Now we know we're paying cash, so cash will be credited. The other part of this is we get to take our discount, and this discount is 1% within 10 days. So 1% of 8,000 is 80. And again, this will be credited to merchandise inventory. because we're paying less than we thought we would for this. So we can't count it at the amount we thought. We have to adjust here a little bit for what it actually cost us. And then the cash would be the 79.20 that we have. So this is how we journalize these types of transactions. And these are the things that we have to look for. We have to pay attention to credit terms. They do tell us here that we have this net of allowance and net of the discount. But sometimes they won't say that. We'll just have a date. So we need to be able to look and say, okay, if we have terms of 110, and the invoice is dated April 18th. Remember, we go by dates on invoices. So we'd look at 10 days from there, the 28th. So as long as we pay by the 28th, we'll get the discount. So this is how we do journalization. Now, the next one I want to look at, there's a couple little problems here, and these are really simple, but I wanted to explain how we look through them. Here we're looking at computing net sales. So we want to look at, and this is from a multi-step income statement. We have the following sales related information. Compare the net sales portion only. So we're only doing the net sales portion here. And for these instances, net sales essentially is what we get from all of our revenue combined, but we subtract any type of discounts, returns, and allowances. And that's how we get net sales. So really we start with essentially gross sales. And we have those here of 200,000. And then we have to subtract less our sales discounts. Sales discounts and less our return and allowance. I'm going to abbreviate. So if we look at it from this respect, our sales discounts we have, it tells us is $4,000, and I'm going to write this as a negative number, minus 4,000. And then our returns and allowances, we had sales returns and allowances of 16,000. So if we deduct that also, this will tell us what net sales is. So basically, all we have to do here is add these up. This plus this plus this, which means we have net sales here of $180,000. Don't get confused. Your sales salary expense is not part of this. Is bottom portion of the income statement. This is the revenue and expense portion. What we're looking at here is just calculating net sales, and net sales is at the top of the income statement. We have net sales minus cost of goods sold gives us our profit margin. So our sales salary expense, don't get mixed up by these things. This should be listed on the income statement down towards the bottom. So this is how we calculate net sales. It's just gross sales or sales minus any returns, allowances, and discounts. Okay. Now, for a multi-step income statement is another thing I'm going to look at here. And on these multi-step income statements are a little bit different, but it's not terrible. We just have a few other things that we have to put in. And let's say the Earth Company reports following income statement accounts for year ended December 31st. We want a multi-step income statement. It includes separate categories for net sales, COGS, selling expenses, general administrative expenses, and then categorizing accounts as selling expenses. There's sales staff salary, advertising expense. So everything else would be general and administrative. So remember, when we talk about a multi-step income statement, really, we talk and we start with sales. It's bolded. It's not. All right, so we start with sales. And we have an amount here. Our sales are $20,000. So we have sales of 20,000. All right. Now, again, we have sales. We want net sales here. So we'll take less sales discounts and less, let's see, what do we have? We have sales returns and allowances. Okay, so our sales discounts that we have here, let's see, they're $750. Our Our returns and allowances are $250. So we're looking at essentially having $1,000 here. So let's see, less sales discounts. I say that. So this would be sum of these two. So then what we'll have here, our net sales will go below this. So we'll just underline this. We'll underline here, bottom border. And this would be net sales. So basically we're looking at our sales minus our returns, discounts, and allowances. So we're looking at net sales in this instance of $19,000. So now at this point, now we have to look at cost of goods sold. And if we take cost of goods sold and deduct that, what we end up getting is gross profit. And our cost of goods sold are $9,000. So we'll put that there. Just over this way a little bit. So cost of goods sold, net sales minus cost of goods sold, again, gives us gross profit. And this would be equal to our net sales minus COGS. So we're looking at a gross profit here, let me underline this, of $10,000. So now we know what gross profit is. Now we have to look at, this is our revenue side. This is the full revenue side of the income statement. So now we're going to look at the expense side. And it tells us here, net sales, COGS, selling expenses. So we have selling and general administrative are going to be the two subcategories of expenses that we have. So we'll start with expenses. And then underneath, we'll start with selling. Selling expenses. Now, let me tidy this up a little bit. All right. So for selling expenses, they tell us up here, we put what? Selling expenses, sales staff salaries. So sales staff salaries, advertising expense. And are those, I think those are the only two that we have. So we have our sales staff salary and our advertising expense, and sales staff salary is $2,500, and our advertising expense is $500. All right, so we put these in, and we're going to total these. Well, we should have an underline here too, just for posterity. They're underlining here, and then we know if we total these up, our total, these would be total selling expenses here. Total selling expenses. The total selling expenses would be the sum of these two, which we'll put as the sum. So we have total selling expenses of $3,000. Now we'll have, we had selling and total selling. Now we'll have our general and what's general and administrative. I think that's what it said. T-R-A-T-I-V-E. So general and administrative expenses are the other part that we have here. And in our general and administrative, they tell us we have what? The remaining expenses are general and administrative. So anything else that's there. Office salaries expense, I see that already, so we'll put that in there. And office salaries expense, $2,000. All right. And then we have rent expense for the office space. Rent expense, office space. And that is $1,500. So let's see, advertising was in selling. Sales returns allowances were used. Office supplies expense. That's not listed as a selling, so Plus, we can think of that as anything in the office is probably not going to be affiliated with what we do in selling. Is insurance expense? Yeah, they said the rest of them were in, so we'll put insurance expense. That was 1,000, and then we have stop is up there. Office rent, office insurance. Is there anything else? I don't see anything. So we'll line these up real quick. And we'll total them out and see what our let's see, total, general, and administrative expenses. So total general administrative expenses, we will sum the expenses up for our general administrative and see what we get. We get $5,000. So we have our expenses are broken down into selling and general and administrative. So now we're going to go down here and we're going to put total expenses because we're going to end up summing those. Align that to the left. And if we look at it, our expenses for selling were 3,000, and for general and administrative, they were 5,000. So our total expenses are 3,000 plus the 5,000 means we have 8,000 in total expenses. So now that we know the total expenses and we know our gross profit, all we have to do now is net income. And net income is our gross profit minus total expenses. So net income would be gross profit here minus total expenses. Net income is $2,000 for this company. So this is how we do a multi-step income statement. And we're going to do a little double underline here. So for Save the Earth Company, they had $2,000 in net income for the year ended December 31st. So this is a multi-step. Remember, multi-step, we start with essentially our gross sales, and we end up with gross profit. We subtract our deductions from sales, which gives us net sales. Then we subtract cost of goods sold. That gives us gross profit, and then we segregate our expenses into. At this point in time, we're going to segregate them between selling expenses and general and administrative expenses. All right, so that's a multi-step income statement. Now, the last problem, quick study 4.9 and 4.10. I was just going to be 4.9, but or 4.10, but 4.9 kind of fits in with it, and we sort of have to do something with 4.9 beforehand. So what we're doing here essentially, and the main focus of this is 4.10, which is where we're going to close revenue and expense accounts. Okay, but the first part, the reason we're looking at 4.9 as well is because we have their ledgers and amounts of accounts here. We know they're using a perpetual, they tell us that. But a physical count of inventory shows that we had 35,900 still available. If we look on our account, it has 37,800. So basically, we've got to figure out right now at this point what we have to do, because what we have in inventory and what we are showing on our statements for inventory does not mesh, and we can't have that. So if we did a little T account here for merchandise inventory and debit and credit side, we know this is an asset, so normal amounts on debit. We had 37,800. Now, it tells us that when we did a physical count, we went in there and counted this stuff. We didn't have that much less. We had a little bit less than that. So we had 35.9. So we've got to think, what do we have to do here? to go from this 37.8 to 35.9. Well, we've got it on the debit, merchandise inventory being an asset has a normal balance on the debit. So if we show 37.8, but we go to count it, and because of shrinkage or spoilage, we only have 35.9, we ought to know we have to credit our merchandise inventory $1,900 to get this amount. So basically, we have to adjust for this. We have to do a little adjusting entry here because of the shrinkage. So what we've got to end up doing here is we can't, if we think about this logically, we have $1,900 here merchandise inventory that's gone. It's disappeared, whether it was stolen, rotted, spoiled, whatever the case may be. We can't sell it. It's gone. We don't own it. We don't have it. So we have to adjust for that. So really, if we look at this from the perspective of, let's journalize this real quick so we can see what we're doing, then what we'll end up seeing here is what we want to do is debit our cost of goods sold, because this is an expense to us. This costs us money losing this inventory. So we'll have our, actually let's spell it out here, cost of goods sold for the 1900, because we lost that inventory somehow. So we have to say, okay, merchandise inventory has to go down by 1900. So if we were to think about this, the first part of this is Q9, because this does come into play in the problem I really want to look at here. We would have a debit to cost of goods sold for $1,900 and a credit to merchandise inventory for 19. What that leaves us our balance of 35.9 in merchandise inventory. But we got to look at cost of goods sold too, because we had to make an adjustment on that. So we got to look at the cost of goods sold here and see what we're doing. Now, cost of goods sold, remember, this is like an expense for us. This is the expense it cost us to purchase things. So we had 105,000 here. And we know if we're debiting that 1900 in that adjusting entry, then that means our cost of goods sold ending inventory is 1069. All right, so when we get down here into closing, we have to know these things because our cost of goods sold ends up getting closed. So for closing, the first thing we'll look at are our revenues here. And the revenues that we have in this is sales. Sales is our revenue. Excuse me for a minute. Oh, maybe. Okay, so sales is our revenue, and we should know revenues are credited. So sales of $160,200 would end up having a credit balance. So to clear that, we've got to debit that. So this will be the 31st, because this is the end of the year closing that we're doing. I believe July 31st. Oops, sorry. Okay. So on July 31st, and we're looking at this, and we're closing our revenues. First one is sales. That's the only revenue we have, actually. Let me do this real quick. Okay. So we'll debit our sales for the amount of sales, 160,200. And what we'll end up crediting here is our income summary. And this is our temporary account that we are going to use to close these accounts too. So this is how we close revenue. Now, if we did a T account of sales here, what we would see is maybe sales we had, what was it again? 162. So we had a $160,200 credit balance, and to close it, we just debit sales 160,200, which means in essence we're starting the next period with zero in sales, and that's what we want, because the next period we're just going to start keeping track of sales for that period. So we just have the one revenue account in sales, so that's all we had to do for it. Now the other thing we have to close are our expenses. So if we look at this and say, okay, this on 7/31, our expenses, closing those. And remember, expenses have a normal debit balance. So to close them, we have to credit them. And we will be debiting income summary. So what we'll look at here is income summary. We won't know the debit amount on that yet. We're going to do our expenses here, and then we'll see what we have as a total of the expenses, and then that'll be our credits, and then we'll total for the debits. So the first thing we have here in expense are sales discounts. All right, and that is going to be credited for 4,700. And then we also have sales returns and allowances for 6,500. Now, cost of goods sold is an expense, but remember, we had to adjust that here. So it's not the 105, it's 1,069. Cost of goods sold. And what was that again? 1,069. Okay. Depreciation expense is another expense. So we will credit that for the 10,300. And then we have two more. Let's see, we have salaries expense, and miscellaneous expense. Now, salaries expense was 32,500. Miscellaneous, 5,000. So, if we want to total these items up, that'll give us the amount we need to credit income summary. So we're going to auto sum these. And we should be, or debiting, I said credit, it should be debiting. We're debiting income summary 165.9. So this is what we're looking at here. If we were to follow this out, it doesn't ask us to, but we'll do it anyways. If we looked at this and copy this over, because we want to do a T account here, or really a T account for income summary. Copy that, paste that. Okay. So if we look at this as income summary, and an income summary, get rid of these for now. We had a credit of 160,200. We had a debit down below over here of 165,900, which means on income summary, we end up having a debit balance of, what is that, $5,700. So basically, if you think about it, and we should be able to see this because sales was 160 and our expenses were higher. So really, we're looking at having a net loss here, not net income. And what we would end up doing, yes, that's not IOM, it's income. What we would end up doing here is we're going to take, if we went the whole way with this, we would take dividends. We would credit dividends, debit income summary, or retained earnings for the dividends, and then we would close income summary by crediting it the $5,700 and debiting retained earnings, $5,700. They're just asking us to do revenue expense here, but if we went ahead with it, like I said, we would close our dividends of 7,000 into retained earnings. So we would have a debit to retained earnings for 7,000, a credit to dividends for 7,000, and then we would close income summary. Since income summary has a $5,700 debit balance, we would end up debiting retained earnings for $5,700 and crediting income summary. And what that would mean is, when we think about it, we would have $12,700 coming out of retained earnings to pay for the dividends and also make up, in essence, for the amount of loss that we had that period. All right, so these are the four problems I wanted to look at. And let's see, I'm going to quit sharing the spreadsheet right now. But let's see, I'll just stop the recording as well. Yeah.